Earlier, we spoke with Laila Brainerd, and she pointed out that companies are not passing on decreases in prices, right? Disinflation. Is that something that the Fed has to consider when it considers the trajectory for inflation?
I think they should. Certainly, inflation is being a bit more sticky. It is going down, but I think this is why we predict that, they're not going to do the 6 interest rate decreases that everyone is expecting, and that could be a trip-off here for the market. But we do think they are going to lower rates, but we think that it's probably not going to happen at least until May.
So you've brought forward then your idea that it won't be until the end of this year. What caused you to do that?
Well, we do see oil prices going down, which is a big driver of inflation. We do see it slowing down enough, and we do see that they don't want to. They want to have a soft landing, and they will need to reduce rates. It's just they're not going to reduce it as many times as the market thinks.
Just a couple of months ago, though, you were very convinced that it would take a whole another year. What has caused you to think that it's going to take only just maybe 5 months now? Is the economy slowing more than you think, or is inflation stickier than you thought?
Well, I think, inflation has really come down a lot quicker than we thought. Like you said, a few months ago, we thought it would take a lot longer for the Fed to reduce rates, but they've actually come out and said that they will reduce rates by 3 times. So we've always been a believer not to fight the Fed. And I think the data confirms the fact that they should reduce rates later on this year, just because inflation is coming down a lot faster. And, the biggest problem is the commercial real estate market and their debt, a lot of refinancing coming. So they don't want to have that bomb here of a lot of foreclosure. So they have to start indicating that rates should be coming down, so that will ease a little bit of the commercial market area, which affects the banks and affects our economy. So I think they're doing the right thing by telling us that they will reduce rates, albeit not as fast as the market thinks.
Laila, how has that been affecting your advice to clients and how they should be positioning themselves if we are indeed finished with the rate hike cycle and going into, in very short order, a rate cutting cycle?
Well, we're definitely starting to lock in some, getting out of short-term bonds, going into more medium to longer-term bonds to lock in these high rates that we have now. We're also looking into getting more into small to mid-cap companies, which is something we have not done for a while. Those companies tend to benefit from potentially lower rates and lower costs in terms of their intakes. So those are the 2 main things that we really think the lower rates are going to affect. And we tend to also start looking into more value stocks, like the 493 companies in the S&P 500. They should start doing better this year.
That's a lot to choose from, Laila. Just curious about your thoughts on the bond market, because you said, you're starting to lock in profits and get out of short-term bonds, and you're looking at medium-term bonds at this point. What did you make of what Bill Gross had to say, that the 10-year looks rich at 4%?
Well, obviously he's the king of, the bond market, but we think, 4% is going to go down as interest rate comes down. So it is a bit, high right now, which is why we're not locking those rates while they're high, because we do think that that's not completely sustainable, and that will, as the Fed reduces rates, those long-term bonds rates have come down quite a bit. I know a few months ago it was almost at 5%. So we've seen a huge drop in the long-term rate, and we think that will continue a bit more as the Fed actually acts.